Well, what the heck is going on with reverse repo? I mentioned this yesterday that I wanted to talk about it yesterday. I just didn't have time to look into it. And today I've been trying to spend some time wrapping my head around the issue. And I think that it's too opaque for me to get any more details than I have. But generally speaking, I see that this is a problem. I see, because Zero Hedge is the one I keep seeing. They keep posting these charts and mentioning it on Twitter. And I do see that there's a problem here. I just don't quite understand what the full implications of it are. So I think maybe talking through what I've figured out so far will help me understand it. And maybe if any of you have any insights, please do comment about it, because I'm no expert in this space by far. So just as a basic foundation, what reverse repo is when these commercial banks have cash and they're going to the Fed and they want to borrow some of the treasury bonds that are on the Fed's balance sheet. And the reason why it's called reverse repo is because, repo, which is short for repurchase agreement, is usually when somebody who has bonds wants to borrow dollars. Reverse repo is when somebody who has dollars wants to borrow bonds. And so Zero Hedge has been posting these charts pointing out at how reverse repo, the amount of the dollar amount of reverse repo that is being conducted at the Fed as of right now is higher than it was in last March at the height of the financial instability when markets were crashing when the lockdowns first started. And so what that signifies is that the commercial banks are flush with cash. They have plenty of reserves. But what they don't have is, our assets. And so they are taking their cash and trying to, even though they can't buy bonds from the Fed because the Fed is not selling bonds, they're trying to borrow them. Because even if it's only overnight, these banks would rather have something on their balance sheet rather than just cash. Now, this is a bit of a peculiar state of affairs, considering that the Fed is working overtime to inject billions and billions of dollars of bank reserves into the commercial banking system by purchasing bonds, treasury bonds, off of these banks' balance sheets. The Fed is going out into the market and buying up federal government debt. And these banks, who the Fed is buying these bonds from, are going to the Fed with the money that the Fed bought these bonds with, and saying, "Hey, will you lend us those bonds that you bought off of us? We want them back. We need them." And so the Fed's actions, which supposedly are always supposed to be in the interest of preserving the stability of the financial system, seems to be inhibiting the commercial banks from doing what they want. These commercial banks would seem as though if they had the opportunity, if there was, if the supply was not being completely inhaled by the Federal Reserve, these banks would like to go out and buy more treasury bonds. And this is kind of where I start to lose, where I start to get outside of my comfort zone. I don't completely understand what I'm talking about. But basically, the commercial banks, the reason why they want to have treasury bonds on their balance sheet is not because they have such a high yield. Treasury bonds yield almost nothing. It's not that they're buying them as assets because they look at them as a way of making money. These treasury bonds are used as collateral so that the banks can go out and borrow more money to do other things. I believe that's the main reason why banks want to hold treasury bonds. From what I understand, if you have treasury bonds on your balance sheet, you can go out and leverage those bonds to get a whole lot more money, which you can then go speculate on other riskier assets. But also, these treasury bonds are used in the repo market. But on the other hand, if there's a relative scarcity of treasury bonds, which is signified by this surge in the reverse repo market, then that would make me think that there is a huge surplus of bank reserves, so therefore the repo market should be fairly quiet. And I mean the regular repo market, which is where banks go when they need cash. And banks normally would present their treasury bonds there and try and get a loan in dollars. So does that mean that banks generally in this case then don't have any trouble getting funding, and we're not going to see something like we saw back in, what was it, late 2019, I believe, the repocalypse, back when the repo rate shot up to like 10%? So I guess that's maybe one conclusion that we can take away from this. But beyond that, the implications are that for whatever reason, these commercial banks, these financial institutions, they need to hold treasury bonds. And the Fed is standing in their way. And these bonds are sort of like they're sort of like the blood of the system, or the lubrication, if you want to think of it that way. There are a lot of financial transactions conducted with these treasury bonds, and I believe that these bonds are considered to be a source of liquidity that is different from just having bank reserves. And so I guess that these not back alley, what's the correct term? Sort of below the surface transactions that ordinary people like me, never see in the financial markets that are conducted with these bonds, are being impeded and are being slowed down by the scarcity of treasury bonds created by the Fed's QE policy. And so therefore, if this continues, if the commercial banks keep having to try and borrow treasury bonds from the Fed just so that they can continue operating normally, well then that would seem to indicate that the financial markets may be very fragile, or I shouldn't say financial system perhaps is quite fragile. And that if these banks are unable at any point to get the necessary supply of treasury bonds that they need, that there will be some sort of problems in the financial system, in the inner workings, in the plumbing, as people say. I think that's what's being alluded to here, because again, well, I keep, I say zero hedge, but there seems to be a lot of chatter aside from them of people talking about this. And I don't know if this is going to turn into a bigger deal. That's why I sound very hesitant, because I don't know if this is a big news story, but I keep seeing it talked about, and I have a lot of questions. And so I'm trying to think through this and understand exactly what it is people are worried about. Now, just to get something out of the way, because it almost goes without saying at this point, especially if you're a long-time listener of this channel, but if there's a problem and the Fed is soaking up too much of the Treasury market and the commercial banks need some more, why doesn't the Fed just stop buying so much? Why doesn't the Fed taper QE? Well, the reason for that we found out back in late 2018, and that's that when the Fed decided to start tapering QE and letting the balance sheet run off on autopilot. We saw financial markets, we saw the stock market, we saw the bond market just completely tumble over a cliff. And so the Fed learned that they have to keep buying up billions and billions of dollars, trillions even, in U.S. federal government debt in order to prop up everyone's retirement accounts. But apparently in doing so, they are inadvertently impeding the function of the plumbing of the financial system itself. And so the people who seem the most concerned about this look at this as the Fed has two options. Either they stop QE and they save the financial system, or they continue QE and destroy the financial system. But in destroying the financial system, they would continue to prop up everyone's retirement accounts. But then again, the destruction of the financial system would destroy the retirement accounts. But in order to save the financial system, they would have to destroy everyone's retirement accounts. It again seems to me like there are no good options left. There's no more off-ramps on this highway. We are still marching headlong down the road to economic ruin. And this is sort of a new dimension, a new layer to the entire impending collapse that I don't know enough about yet. But I wanted to get something out there about this before something happens, because considering how big the number looks on the chart, and you know what, maybe I'll try and link to it or something, but you know, it's not that big of a deal. The point is the banks are starved for treasuries, and that does have an impact. I know enough about how the plumbing of the American financial system works, even though, again, I've not done enough of a deep dive into the financial iceberg to understand the full implications. But I do understand that there are implications there. And I know that the Fed thinks that there are implications too, because the Fed last week was talking already about tapering QE, which again to me sounds like, you know, total suicide. Now I don't think that they're going to do it, but they were talking about it, which is significant. And that to me signals that they see that there's a problem here too with all of this reverse repo and the lack of access for the commercial banks to treasuries. So it's sort of a question here of what does the Fed want to ruin first? Do they want to continue to prop up the bond market and potentially cause the banking system to seize up? Or do they want to try and keep the banking system operating normally and blow up the bond market, which then will blow up the stock market and the housing market? And additionally, I don't know what sort of timetable there is for what we're seeing here. I don't know how long these elevated levels of reversed repos can last. So maybe I'll try and talk about this tomorrow, but with that said, I think I'll end it off here.